$100,000 could vanish from your retirement nest egg if you follow Jim Cramer's top picks into concentrated positions before age 65. Most investors nearing retirement don't realize this until it's too late. You've watched Jim Cramer on CNBC. He's confident, he's specific. He names stocks on live TV with authority. It feels like research. It feels like it beats the market. But what does his actual win rate show? That's what we're analyzing today, and the gap between his image and his track record could reshape your retirement timeline. By the end of this video, you'll know Cramer's exact pick accuracy, how it compares to a simple S&P 500 index fund, and why chasing his calls could cost you $80,000 to $120,000 in retirement purchasing power over a 20-year horizon. This is especially critical right now because interest rates sit at 50% per the Federal Reserve, making capital preservation and compound growth worth more than ever. Let's start with a hard number. Jim Cramer's published stock picks show a win rate of approximately 45-55% over rolling 3- and 5-year periods from 2020 through 2024, according to analysis by multiple financial media outlets including tracking compiled from CNBC-owned archives. That's coin flip accuracy. After accounting for trading fees, bid-ask spreads, and capital gains taxes at 15-20%, his recommendations have underperformed the S&P 500 by 2-5% annually in the same periods. The S&P 500 itself averaged 10% nominal returns over the past decade. Cramer's picks trailed that by at least 200 basis points per year on average. Now here's where it gets worse for pre-retirees. A household with $500,000 in invested assets who reallocates 40-60% of that, $200K, $300K, into 3-5 of Cramer's concentrated picks, instead of maintaining a diversified 60/40 index strategy, exposes themselves to plus or minus 15-25% portfolio swings, $75K, $125K in absolute value, within 12-24 months. If those picks underperform by 3% annually for 5 years, that's a $75,000 gap versus the index fund, before taxes. But the tax drag is what actually compounds the damage. Every time you sell a winning position early to chase the next Cramer call, you trigger capital gains. If you're in the 20% federal long-term capital gains bracket, plus state taxes, selling a $50,000 winner costs you $10,000 in taxes immediately. IRS Publication 550 makes clear that frequent trading and concentrated repositioning are taxable events. There's no free lunch. A $500K portfolio recycled annually between Cramer picks could bleed 2-4% per year in pure tax drag. $10K, $20K. Money that never compounds. Let me show you the dollar impact over time. A household age 45 with $500K invested and 20 years until retirement. If they follow a diversified 60/40 strategy earning 7% real returns after inflation, they compound to approximately $1.95 by age 65. If they follow Cramer's picks at 50% accuracy and face 3% annual underperformance plus 3% tax drag, they end up closer to $1.38, a $570,000 gap. After inflation adjusts that gap back to today's purchasing power, retirement income drops by roughly 12-15%, or $20,000, $30,000 per year in sustainable withdrawals. The behavioral trap is the real killer. Cramer's confidence and specificity trigger a psychological bias called recency bias. We remember his winning calls, Apple in 2022, certain bank picks in 2023, and forget the duds. Our brains are wired to chase momentum and confident voices. But that same wiring costs concentrated investors 1-2 years of retirement life, or forces a 10-20% cut in spending when they finally stop working. That's not theoretical. That's your mortgage, your travel, your healthcare freedom. The research is clear. Behavioral investors who chase prediction-based signals underperform buy-and-hold diversified investors by an average of 1% annually, according to studies by Vanguard and Morningstar. That gap compounds into 6 figures by retirement. So what should you do instead? For dividend income investors nearing retirement, the case is even stronger for diversification. A 60% diversified equity fund, like VTI or VOO, paired with 40% income-producing bonds or dividend-focused ETFs delivers more predictable cash flow, lower volatility, and tax efficiency than chasing 3-5 concentrated picks. You'll sleep better, and your portfolio will compound faster. The full implementation framework, sector rotation, tax loss harvesting, and income tier structure for retirement is covered in depth in the companion book Market Cycles Decoded link in the description. Here's the bottom line. Jim Cramer's picks are not wrong because he's malicious. They are underwhelming because prediction-based stock picking is inherently hard to execute profitably after fees and taxes. The S&P 500 doesn't require genius, it just requires patience. For investors within 10-20 years of retirement, patience compounds into freedom. Prediction chasing compounds into regret. If this analysis changed how you think about celebrity stock picks, hit subscribe. Next video drops Wednesday. We're breaking down the hidden tariff winners nobody's talking about yet. Ring the bell so you don't miss it. What's your biggest takeaway from your own experience following high-profile stock calls? Drop it in the comments. Markets reward the patient and the prepared.